Welcome into this week's On the Spot. I'm Tony Mulvey, joined on the phone by Kevin Hill. Kevin, how are you?
I'm doing great, Tony. How are you doing this morning?
You know, I can't complain. The market is kind of in this weird state, and really the interesting part is what's going on in the diesel market. We've seen rack prices really rise. We've seen the retail price really start to flatten out, and now we're seeing that squeeze that we saw kind of back earlier in the year where those diesel retail prices rose up, where rates were falling. That squeeze is kind of on again.
It is. I think we've been talking about peak inflation and peak oil, or not peak oil, peak diesel prices, I should say. And you know what? There's also the possibility of fits of stops and starts, ramp ups, being followed by downturns a little bit, and kind of a bouncing, undulating market for a while.
Yeah, so that chart you just saw was that diesel price, the retail price and the rack price. And you can kind of see, we talked about it with Donnie a little earlier today. You see that spreads went from basically $1.70 about 2 weeks ago. Now it's at $1. And I think that sudden shift is going to really cause this retail price to start to really increase.
It will, and it comes back to the spot market and fuel surcharges. And if you're doing any bids on the contract market, let's say as a freight broker, a 3PL, or a carrier, line haul rates are pretty stagnant, kind of dipping down again. If fuel prices start going up, they're going in opposite directions, and it becomes a little bit of a calculus to understand your rates and then forecast that out. It becomes very difficult.
Yeah, we'll pull up this next chart. It'll be that rack price and the NTI. And you kind of see, or actually it's just the rates for this one. So we see contract rates and spot rates both falling really quickly. I mean, $2.75 contract rate, spot rate there in the white line, even lower at $2.65. I mean, we're seeing these declines in what is revenue for these carriers as a whole. I mean, both those that are spot exposed and exposed to the contract market, and those that are exposed to the spot market.
And if I'm reading this right, the white line, which is the NTI, is with fuel. The blue line, which is contracted rates, are without fuel. Is that right?
Yep, that's correct.
Okay.
Yeah. So you have one that's impacted by fuel, the other one, that blue line, not. But I mean, what's really interesting is as we said in that first chart, you see the rack price moving up, diesel prices still at $5, or retail diesel prices, which those spot carriers have to pay, as opposed to the ones that are under contract, where they can buy at rack and sell, and basically
lower.
Charge that, sometimes lower, and then they turn around and make money on the spread there between diesel, the retail and the rack price. So I think what's interesting, and we'll bring up one more chart, and it's one that I put together, just kind of looking at, we talked about it, the cost of diesel as on a per mile basis. And we kind of backed into about an 8 mile per gallon average, and then kind of looked at it on a range bound between 6.5 and 9.5 miles per gallon. You see what the costs have done. They've gone up basically right in that 51% year over year. You've seen the NTI fall on average. These are average rates. And what's interesting, those less fuel efficient carriers, right, that are getting that 6.5 miles per gallon, their fuel expense as a percentage of revenue, if all their revenue is coming from the spot market, is almost 25% now.
It is, I mean, it's quite a squeeze, right? I mean, if you look at NTI excluding just the line haul portion of it, it's down about 30% from the February highs. If you look at diesel, if you're running 8 miles a gallon, you're looking at a 20% increase. And talk about getting squeezed, it's coming from both sides right now, which makes it very difficult to operate in the spot market and be profitable and to work out a business.
Yeah, and those are averages over the course of the year to date. And I think that's the key, right, is we look back at the beginning of the year, diesel prices were elevated compared to where they were a year ago, but they weren't $5 a gallon. And I think as we see these prolonged periods where we see that rack price start to rise up, it's going to create an additional increase in the retail price. Well, guess what? It means those average continues to move higher. We're seeing spot rates continue to fall down. They've been squeezed, these carriers have been squeezed, and it seems like that squeeze is going to tighten even more here in the next, say, 6 to 8 months.
Yeah, fleets that are operating on the margin or at the margin, the ones that are performing in the bottom 5-10% of all fleets out there, it's going to be a very difficult second half or peak season. And then January, the first quarter of next year is really going to, if diesel prices stay this high or move higher from here, it is going to be very tough for people to build out a business plan or like a realistic path forward through 2023 come January, February.
Yeah, I mean, especially when you start figuring in those comps of the first quarter, when you think about how we were in January and February of this year, right? We didn't really see this change in the market until March, which is only, 1/3 of a quarter. So, I mean, those, given how the market conditions are right now. But Kevin, thank you so much for joining me this week on this week's On the Spot. We'll be sure to check in with you again on Tuesday for the next edition of the Research Corner. Right now, we'll take a quick break, but we'll be back with more Freightwaves Now.